Ever wonder how some companies get so big, or how people make money in the stock market? Think of it like this. Remember setting up a lemonade stand as a kid? You needed money to buy lemons and sugar, right? Well, when companies need money to grow, they sell something even sweeter than lemonade stocks. In this video, we're going to break down the basics of stocks and investing. So even if you've never bought a single share, you'll understand how it all works. So grab your notepad and let's get started. Remember that lemonade stand? The one where you and your friends sold lemonade to the neighbors on a hot summer day? Let's say instead of just a one-time thing, you wanted to turn it into a huge business. You dream of having lemonade stands all over the city, maybe even across the country. To make that dream a reality, you need money for better equipment, high-quality ingredients, and maybe even employees to help you run the stands. So you decide to sell shares of your company. These shares are like little pieces of ownership that you offer to investors in exchange for the money you need. Think of those shares as tiny slices of your lemonade empire. Each slice represents a small part of your business. Each share gives the investor a small ownership stake in the company, meaning they own a piece of your lemonade business. Now imagine your lemonade stand blows up and becomes the next big thing. Your stands are everywhere, and everyone loves your lemonade. Suddenly, everyone wants a piece of the action, and those shares become super valuable. Take Apple, for example. Back in 1980, when they first went public, you could have snagged a share for about $22. It was a small investment back then. Today? Well, let's just say you'd be sipping lemonade on a private island somewhere because Apple's stock price is now in the hundreds of dollars. That small investment would have grown tremendously. The stock market is where these shares are bought and sold. It's like a giant auction where people are constantly buying and selling pieces of these companies, hoping to make a profit. So we know that companies sell stock to raise money, but why? Well, it all boils down to growth. Think about it. To expand your business, you need capital, right? Whether it's building new factories, developing new products, or hiring more employees, all of that requires cold, hard cash. One way companies raise this capital is through an initial public offering, or IPO. It's basically the first time a company sells stock to the public. It's like that grand opening for your lemonade stand, where you invite everyone to invest and be a part of your journey. But IPOs aren't the only way companies raise money through the stock market. They can also issue more stock later on through something called a secondary offering. By selling more stock, companies can fuel their growth, expand into new markets, and ultimately achieve their business goals. Now let's flip the script and talk about why people buy stocks. It's a fascinating topic that delves into the psychology and strategy behind investing. Why would anyone want to own a tiny piece of a company? Well, there are a couple of key reasons. For many, it's about being part of something bigger, a way to support companies they believe in. First off, there's the potential for profit. Investors are always on the lookout for opportunities to grow their wealth. As we saw with Apple, Amazon, and Tesla, when a company does well, its stock price tends to go up. This can lead to significant financial gains for those who invested early. And if you own shares in that company, you get to ride that wave of success. It's an exhilarating experience to see your investments grow. It's like buying a piece of land hoping its value will appreciate over time. The longer you hold on to it, the more potential it has to increase in value. But it's not just about the price going up. There are other benefits to owning stocks. Some companies also pay out a portion of their profits to shareholders in the form of dividends. This can provide a steady income stream. Think of it like a bonus for being a loyal investor. It's a reward for your faith in the company's future. Of course, just like with any investment, there are risks involved. The stock market can be unpredictable. Stock prices can go down as well as up, and dividends are never guaranteed. It's important to do your research and understand the market before diving in. Chapter 4. Where stocks are bought and sold. So, you're probably wondering where all this buying and selling of stocks actually takes place, right? Well, it happens on stock exchanges, which are basically marketplaces for stocks. Think of them like giant trading floors, but instead of yelling traders in colorful jackets, it's mostly done electronically these days. Some of the most well-known stock exchanges include the New York Stock Exchange, the Nasdaq, and the London Stock Exchange. These exchanges are where companies list their stocks, and investors from all over the world can buy and sell them. With online brokerage accounts, you can buy and sell stocks from the comfort of your own home. Chapter 5. Basic Concepts. Now, let's dive into some basic concepts that will help you understand how stocks are valued and what to look for when evaluating investment opportunities. One important metric is market capitalization, or market cap for short. This represents the total value of a company's outstanding shares and is calculated by multiplying the stock price by the number of shares outstanding. Another key metric is the price-to-earnings ratio, or PE ratio. This compares the company's stock price to its earnings per share and gives you an idea of how expensive the stock is relative to its earnings. Other important financial metrics to consider include price-to-book ratio, debt-to-equity ratio, and return on equity. These ratios provide insights into the company's financial health, profitability, and management effectiveness. Remember, understanding these basic concepts is crucial for making informed investment decisions. Chapter 6. Risks and Rewards. Investing in the stock market can be a roller coaster ride, with periods of exhilarating highs and stomach-churning lows. It's important to understand that while there's potential for significant rewards, there are also inherent risks involved. One of the biggest risks is market volatility. Stock prices can fluctuate wildly in the short term, driven by factors such as economic news, geopolitical events, and even investor sentiment. We've seen this firsthand during events like the 2008 financial crisis and the dot-com bubble. While these events can be unsettling, it's important to remember that the stock market has historically trended upwards over the long term. The key takeaway here is that investing in stocks is a long-term game. Don't panic sell during market downturns. Instead, stay focused on your investment goals and ride out the volatility. Chapter 7. Diversification. You've probably heard the saying, "Don't put all your eggs in one basket." Well, the same principle applies to investing. Diversification is the practice of spreading your investments across different asset classes, industries, and geographies to reduce your overall risk. Think of it like this. If you invest all your money in a single stock and that company goes bankrupt, you could lose everything. But if you diversify your portfolio across multiple stocks, bonds, real estate, and other assets, the impact of any single investment on your overall portfolio will be minimized. Asset allocation is another important concept related to diversification. It refers to the strategic distribution of your investments across different asset classes based on your risk tolerance, time horizon, and financial goals. Chapter 8. Starting small. Now that you have a basic understanding of stocks and investing, you might be wondering how to get started. The journey of investing can seem daunting at first, but taking the initial steps is crucial. The good news is that it's easier than ever to begin investing, even with a small amount of money. Modern technology and financial tools have made the process accessible to everyone. The first step is to open a brokerage account. This account will serve as your gateway to the stock market and other investment opportunities. This is where you'll buy and sell stocks. It's important to choose a brokerage that fits your needs and offers the tools and resources you require. There are two main types of brokerage accounts: traditional brokers and online brokers. Each has its own set of advantages and disadvantages. Traditional brokers offer personalized advice and services, but typically charge higher fees. They can be a good choice if you prefer a hands-on approach and need expert guidance. Online brokers, on the other hand, provide a more DIY approach with lower fees. They are ideal for those who are comfortable managing their own investments and want to save on costs. If you're not comfortable buying individual stocks, you can consider investing in mutual funds or exchange-traded funds, ETFs, which are baskets of stocks that track a particular index or sector. These options offer diversification and can reduce risk. Remember, the key is to start small, invest consistently, and gradually increase your investment amount as your income grows. Patience and discipline are essential for long-term success in investing. Chapter 9. Important note. Before we wrap up, I want to emphasize one crucial point. Investing in the stock market involves inherent risks. While I've shared valuable information to help you get started, it's essential to conduct thorough research and seek professional financial advice before making any investment decisions. The stock market is constantly evolving, and what works for one person may not necessarily work for another. Your investment strategy should align with your individual financial goals, risk tolerance, and time horizon. Remember, investing is a marathon, not a sprint. Outro: start investing today. And there you have it. You've just taken your first steps into the world of stocks and investing. Remember, building wealth takes time and effort. But by understanding the basics, you're already ahead of the game. Now go out there, do your research and start investing in your future.